Think about the last time you opened your retirement spreadsheet and actually liked what you saw. You're close to 60. The finish line is visible. You run the projection again. Then you do what responsible people do. You decide you're going to max out your IRA for the year, just like you've done before. Your bonus hits. You move money over. Maybe it's one clean transfer. Maybe it's an automatic monthly contribution you set and forgot. Either way, you feel ahead. Like you're finally playing offense. Then months later, usually at tax time, you get the message you didn't see coming. Your contribution wasn't allowed, and your brain short circuits. Because nothing about your life looked reckless. You didn't day trade. You didn't miss a bill. You didn't do anything weird. You just saved for retirement. Here's what most people don't realize. This problem usually has nothing to do with the market. It's a rule baked into your income. A rule you only learn about after you've already done the right thing. And by then, fixing it can turn into paperwork, penalties, or both. Let me be clear about something. Your IRA contribution isn't only controlled by the yearly dollar cap. It's also controlled by your income. Specifically, a number called MAGI, Modified Adjusted Gross Income. That's basically your tax return's income number after a few adjustments, and it's what the IRS uses to decide whether you get to use certain benefits. Here's the twist. IRA benefits don't just stop. They phase out. For Roth IRAs, once your MAGI enters the phase-out range, the amount you're allowed to contribute shrinks. And if you go over the top of the range, your allowed contribution can drop to zero, according to IRS Notice 2024-80. For 2025, the Roth IRA phase-out range is $150,000 to $165,000 for single filers, and $236,000 to $246,000 for married filing jointly. So that normal move you made, transferring money into your Roth IRA early in the year, can quietly become an ineligible contribution if your final, full-year income lands too high. And you often don't know that until the year is basically over. Bonuses, RSUs, side income, a spouse going back to work, even investment income, your MAGI moves. That's the trap. You act in March. The rule judges you in December. Then you're left with an excess contribution problem, which means you have to clean it up correctly and on time or deal with avoidable penalties. And yes, it goes deeper than that. Once you see the income gate, the next aha is realizing there are two different rulebooks people mix up. Rulebook 1 is the contribution limit, the max you're allowed to put into IRAs for the year. Rulebook 2 is eligibility, whether you're allowed to contribute to a Roth at all, and whether your traditional IRA contribution is deductible. Deductible just means it lowers your taxable income. If you're covered by a retirement plan at work, that deduction can shrink or disappear as your MAGI rises, even if you can still deposit money into the IRA. The IRS lays out how sharp this can be. For Roth IRAs in 2025, IRS Notice 2024-80 shows the married filing jointly phase-out range is $236,000 to $246,000 of MAGI. That's a $10,000 window where the permitted amount slides down from full to zero. Now picture someone like Marcus and Dana, late 50s, steady earners. In January, they toss the full Roth IRA amount in because they did it last year and nothing felt different. Then Dana's late-year bonus lands and their MAGI drifts into that phase-out window. Suddenly, only a partial Roth contribution was allowed. The extra they already contributed doesn't become nice extra savings. It becomes an excess contribution. What does that mean for you? It means the cleanest-looking behavior, automation, consistency, set it and forget it, can still create a compliance problem. Because eligibility is judged on your final, full-year MAGI, not your paycheck at the moment you clicked contribute. So the real skill isn't just saving. It's saving in the right lane. And once you understand that, the next question is obvious. Why do so many people only find out when it's too late to avoid the mess? The timing is what makes this feel like a setup. You contribute early because you're organized. Or you do monthly contributions because it's simple. But MAGI isn't known until the year is over. High income is rarely smooth, and near 60 you often have more moving parts, bigger bonuses, stock comp, side income, capital gains, even a spouse's income changing. Here's a very common landmine. RSUs, restricted stock units. When they vest, their value is treated like regular wages on your W-2. The Baker Avenue explanation of RSU taxation spells it out. At vesting, the fair market value gets included as ordinary income on your W-2. So you can think you're safely under the Roth limit, and then one vesting event hits and spikes your income for the year. Example. Imagine you're cruising, you've already contributed to your Roth in the spring, and then in December your company stock vests. The value shows up as wages. Your MAGI jumps. Now your allowed Roth contribution might be reduced or even wiped out, depending on where you land. The punchline is brutal. You didn't do anything wrong operationally. You couldn't even see the final number yet. What does that mean for you today? You can't use last year as your guide. You need guardrails, a quick mid-year check, a Q4 projection, something that assumes your income can surprise you, because the people who get trapped aren't careless. They're predictable, and the system punishes predictable. Now let's talk about what happens when you're already over the line, because the cleanup isn't intuitive, and the cost isn't just money. You've seen how the trap happens. Now you need to see the part nobody explains at the beginning. What the IRS calls this mistake, what it costs each year, and the exact paperwork moves that keep it from snowballing. Because once it's labeled excess, it stops being a simple savings habit and starts being a tax problem with a clock. An excess IRA contribution isn't just extra money in a retirement account. It's money the IRS says shouldn't be there under the rules for that year. And if it sits there, the IRS charges you for the privilege of leaving it uncorrected. Then comes the messy part. You have to pick the right fix, get your custodian to process it correctly, and make sure your tax forms match what actually happened. Here's the concrete bite. The IRS says excess contributions are taxed at 6% per year for each year the excess amount remains in the IRA. That's straight from the IRS Retirement Topics, IRA Contribution Limits page. Not one time. Every year it's still there. And to avoid that 6% tax, the IRS says you must withdraw the excess contribution by your tax return due date, including extensions, and also withdraw any income earned on that excess. So imagine a high earner who auto-maxed a Roth in January, finds out at filing time they're over the limit, and they panic withdraw the contribution, without asking for the proper excess removal calculation. Now the custodian has to deal with earnings attributable to that excess, and your tax reporting can get weird fast. What does that mean for you? This isn't only about paying a penalty. It's about preventing a repeat penalty, avoiding a paper trail that doesn't match your return, and not turning one over-the-line year into a multi-year cleanup. So what do you actually do with all of this? Without living in spreadsheets or playing guessing games all year, here's exactly what to do. Simple, repeatable, and it keeps you out of the phase-out trap. Step 1. Build a MAGI early warning check. 2 dates. Mid-year and early Q4. Pull your paystub YTD. Add expected bonuses, commissions, RSU vesting, spouse income, and any known capital gains. You're not being perfect. You're finding danger zone. Step 2. Put guardrails on contributions. If you're anywhere near the phase-out window, don't auto-max in January. Contribute conservatively or pause, and only top up when Q4 numbers are clearer. Step 3. Choose the lane on purpose. If Roth eligibility is questionable, don't assume. If you're covered by a workplace plan, also don't assume your traditional IRA is deductible, because a non-deductible IRA means you must track basis on tax forms. Step 4. If you already contributed and later crossed the line, act fast. Identify which mess you have: A. An excess contribution, or B. A deduction that's not allowed. Then contact the custodian and ask for the correct correction method so the 1099-R matches what you file. Decision rule for any AR-60U. If income is variable or close, you don't max by default. You forecast first. If this was useful, the next thing you'll want is a clean, near-retirement income checklist that catches the other benefits that phase out the same way. Subscribe for more of the rules the system doesn't explain up front, and drop a comment with what makes your income jumpy: bonus, RSUs, commission, or something else.